In his office, Joseph Kennedy was calm. As the prices crashed, the value of his short positions skyrocketed. He was making millions of dollars an hour. While the wealth of the nation was being incinerated, Kennedy was engaging in the greatest harvest of wealth in his life. He eventually closed his short positions, buying back the stocks for pennies on the dollar. By the time the dust settled in 1930, Joseph Kennedy was one of the richest men in America. His fortune was secure, and because prices of everything, mansions, land, businesses, had collapsed, his cash could now buy 10 times as much as it could have a year earlier. He didn't just survive, he ascended. Now, why am I telling you this story in such detail? Why does a bootlegger from the 1920s matter to you today in January 2026? Because we are living through the exact same script. The actors have changed, the technology has changed, but the plot is identical. Well, let's look at the parallels. In 1929, the new era technology was radio and electricity. In 2026, it is artificial intelligence and robotics. Just like in the 20s, we have seen companies associated with AI skyrocket to valuations that make no mathematical sense. We are told that this time is different because AI will change everything. And just like radio, AI will change everything. But that doesn't mean the stock prices are justified. In 1929, the signal was the shoe shine boy. Look at your world today. Look at your social media feed. For the last 2 years, financial advice has been democratized to a dangerous level. We have FinTok influencers with no experience telling teenagers to trade options. We have people trading 0 DTE, 0 days to expiration, options on their phones during their lunch breaks. We have regular people struggling to pay for groceries who are leveraged to the hilt in speculative cryptocurrencies. The retail saturation is total. Your Uber driver is asking you about the Fed pivot. Your dentist is giving you tips on the next short squeeze. The shoe shine boy is all in. There's nobody left to buy. But the most terrifying parallel is the leverage. In 1929, it was the $8 billion in brokers' loans. In 2026, the leverage is hidden, but it is exponentially larger. It is the derivatives market. The global financial system is sitting on a quadrillion-dollar bubble of derivatives, bets on bets on bets. And specifically in the US stock market, the volume of options trading has surpassed the volume of actual stock trading. People aren't buying shares of companies anymore. They are buying gambling contracts on the price movements of those companies. This creates gamma squeezes that drive prices up artificially, just like the pool operators did in the 1920s. But the ultimate form of margin debt today isn't just in the stock market. It is the national debt. In 1929, the US government was solvent. Today, in January 2026, the US national debt has crossed $35 trillion. The interest payments on this debt are now the single largest line item in the federal budget. We are borrowing money just to pay the interest on the money we already borrowed. This is a margin position on a national scale. The US government is the ultimate degenerate gambler, using printed money to prop up the economy. And just like Kennedy saw in 1929, the liquidity is drying up. We have seen the warning shots. We have seen the yield curve remain inverted for longer than at any time in history. An inverted yield curve has predicted every single recession since 1950 with 100% accuracy. To ignore it is to ignore gravity. We have seen the insider selling. This is a metric Kennedy would have loved. In the last 6 months leading up to today, January 2026, the CEOs and founders of the Magnificent Seven tech companies have sold billions of dollars of their own stock. Think about that. If Mark Zuckerberg, Jeff Bezos, and Elon Musk believed that their companies were going to double in value again, they would be buying. But they are selling. They are cashing out. They are doing exactly what Joseph Kennedy did in the summer of 1929. They are distributing their shares to the retail public, to the shoes shine boys, before the music stops. They know the crash is coming. They are preparing.